Volunteers Mahadi. In this video, we'll talk about transnational audit. First and foremost, I'll explain the meaning of transnational audit. A transnational audit means an audit of financial statements which are or may be relied on outside the audited entity's home jurisdiction for purposes of significant lending, investment, or regulatory decisions. This will include audits of all financial statements of companies with listed equity or debt and other public interest entities which attract particular public attention because of their size, products, or services provided. As defined in ISA 600, the definition of a transnational audit should be applied to the whole group audit, including all the components whose financial information is included in the group financial statements. The audit of an individual component of a group could, however, be a transnational audit without the group audit being transnational if the component qualifies under the criteria. If an individual component of a group qualifies under the requirements, the audit of that component could be considered a transnational audit without the group audit being considered a transnational audit as a whole. Large charitable organizations or trusts, major monopolies or duopolies, providers of financial or other borrowing facilities to commercial or private customers, deposit-taking organizations, and those holding funds belonging to third parties in connection with investment or savings activities are examples of entities for which the audit may be considered transnational due to their size or the nature of the products and services they provide.
Hi, Assalamualaikum. My name is Ahmad Farah Hakim and I will continue to the next slide, which is literature review regarding transnational audit. So for the first article, according to Payment 2031, in his article Transnational Auditor, Local Workplace and the Law, Global Supply Chain Auditor have a significant impact on determining what is meant for manufacturing facilities to comply with both transnational standard, national and international labor laws. They play this role at a crossroad of a local context of workers in a workplace governed by local and national laws and the transnational context of private standard intended to govern global supply chain. So for the next article, according to Zamiman et al. 2035, article Accounting Firm Global Reach Without Transnational Form, the Big Four employ more than 500,000 people and has a combined revenue of more than $100 billion across all three service lines. This figure places them on a par with an international corporation from other industries. However, the Big Four accounting firms differ from a majority of global players in three significant ways. For starters, they are part of a professional service firm category.
A study from RCS and McLeod 1991 states that financial reporting entails the release of financial statements such as a profit and loss statement and balance sheet, together with other information including notes and a management report and a report from independent auditors.
Features of traditional audit. First, application of auditing standard. This means that in traditional audit, some component of the group financial statement will have been audited using a different auditing framework, resulting in inconsistent audit process within the group and potentially lowering the audit overall quality. Second, regulation and oversight of auditor. Similar to the previous comment on the use of ISAs, there are numerous ways in which auditor activity are regulated and monitored around the world. In some countries, the audit profession is self-regulated, whereas in others, a more legislative approach is used. Third, financial reporting framework. Some countries use international financial reporting standard, while others use locally developed accounting standard. It's likely that adjustment, reconciliation, or restatement will be required within a transnational group in order to comply with the requirement of the jurisdiction relevant to the group financial statement. 4. Corporate governance requirement and consequent control risk. In some countries, there are very prescriptive corporate governance required that the auditor must consider as part of the audit process. In this case, the auditor may not go above and beyond local requirement to ensure group-wide compliance with the requirement of the jurisdiction relevant to the financial statement. Concept of transnational audit. According to the PCAOB 2016, the International Standard of Auditing ISA 600 serves as the foundation for global network for methodology. According to the standard, the group auditor is responsible for directing and supervising work related to the financial statement audit opinion for a consolidated entity as well as the work performed by a component auditor. This means that the group auditor is in charge of the overall audit strategy and methodology at both the group and component level. Furthermore, the group audit is required to discuss the risk of performing audit work with the component auditor, communicate the requirement and relevant information, and evaluating the component auditor's works. As a result, in order to evaluate, the group audit must discuss the significant issue that arisen and determine whether additional documentation must be reviewed. IFAC 2007. The associate bodies involved in international audit are the Transnational Audit Committee, Forum of Firm, and International Associate Education Standard Board. Firstly, the Transnational Audit Committee, which is known as the TSC, is a IFSC, a standing committee. IFSC, a Transnational Audit Committee, TSC, that has responsibility for transnational audit. TSC representative and role is to detect concern with the audit practice. When issues indicate the changes to the audit or assurance standard may be necessary, request that the matter be evaluated by the appropriate IFAC standard setting board. Secondly, the Forum of Firm, also known as FOF. The Forum of Firm is an independent associate of international network of firms that perform transnational audit. The objective is to make sure that financial reporting and auditing practice around the world are the same and high quality by bringing together firms that do cross-border audit and getting them more involved with the IFSC work in the audit and other assurance-related areas. Membership in the Forum of Firms impose commitment and responsibilities such as performing transnational audit in compliance with ISAS, in complying with the IESBA Code of Ethics for Professional Accountants, and being subject to a quality assurance program. Last, the International Accounting Education Standard Board, IAESB, is a part of IFAC the same way the IAASB and IESBA are, so it's important accounting member to learn what is they need to know. It's a goal to help the public by setting standards for professional accounting education that require technical skill and professional skill, as well as value, ethics, and attitude that are important to people. The main goal of IAESB is to improve the education and training of auditors around the world, which should lead to better audit. In its own word, the accountancy profession need to make sure that people who become professional accountants meet a certain level of competence.
Next, for concerns of transnational audit. First, under group's audit cost, the primary auditor and client will agree on the fee before the commencement of the engagement, and it will be included in the engagement letter. This is vital for the assigned to keep in mind in order to maintain the audit quality. The audit fees paid to the chief auditor and for the service of additional components auditor, such as foreign entities, make up the multinational group's audit fee. As a result, the principal auditor must oversee additional audit work performed by other component auditors. Second, group audit quality. Concern regarding the quality of multinational business group audits has been raised by ISA 600 modification among the major international standard setting organization AASB 2007. This is so that the audit opinion that is given on the financial statement of the corporate group can be attributed to the audit partner of the major firm. As a result, the signing partner must ensure that every component of the engagement is carried out to same high standard.
Now, let us look into the challenges of transnational audit. The first challenge is some countries use IFRS while others use accounting standards developed locally. It is likely that adjustments, reconciliations, or restatements will be required within a transnational group in order to comply with the requirements of the jurisdictions relevant to the group financial statements. The need to integrate the results of group and component teamwork to produce the final opinion leads to work interdependence in auditing. In the context of global group audits, it is proposed that the difficulties associated with performing interdependent work are likely to further increase by complexity arising from client characteristics and nature of the work, the structure of the engagement, and cultural or language barriers. A citation from Puranam and Ravindran 2012 states that when work is interdependent, coordination and communication failures such as delays and misunderstandings can occur when the actions of others are difficult to predict. The second challenge is communication difficulties are likely to increase as the client grows larger and the work becomes more complex. A citation from Hay, Knatchell, and Wang 2006 states that due to differences in a local jurisdiction, component auditors in other countries will find it difficult to predict and understand the group auditors' actions and instructions when the companies require more extensive audit work. Furthermore, a study by Hayes and Bailey 2003 found that larger companies are more likely to engage in transactions that are more complex to the components auditors' work, which will increase the auditors' coordination and communication costs, potentially leading to challenges in performing the engagement. The third challenge is the organizational structure of the group audits may differ, such as the involvement of other teams, multiple levels of reporting, and the component statutory audit responsibilities. The structure of a multinational group audit may differ depending on the number of components located around the world. According to Station from Downey and Bedard 2019, this is due to the fact that as the number of components grows, the group auditor must explain the audit strategy to more component teams and monitor their work in order to assess the sufficiency and appropriateness of the evidence obtained. Finally, as stated by Public Company Accounting Oversight Board PCAOB 2016, language and cultural differences can make it difficult for component auditors to engage in foreign jurisdictions where the client does business. A citation from Nolder and Riley 2014 states that this is due to the possibility of greater variation in team members' judgment and decisions. And a citation from Kisler and Cummings 2002 states this is making it difficult for teams to establish mutual understanding.
Next, we move to the issue on transnational audit. So the issue will focus on linguistic consideration. The majority of the literature on interlanguage communication focus on language learning, specifically scenario in which the communicator is a native speaker of the source language but has little proficiency in the target language. Therefore, the many copying strategy that the communicator may use to get over this lack of linguistic proficiency in the target language are given a lot of attention in the literature. Instead, the issue is the difficulty of changing from a professional register in one language to a professional registration in another language. The two national registers in question could be very similar or quite dissimilar depending on the scope of any international registry. First and Casper 1983 distinguished between two approaches to interlanguage communication: reduction strategy, which are controlled by avoidance behavior, and achievement strategy, which are deliberate attempts to address the difficulties of communicating in a foreign.
In conclusion, the transnational audit should be applied to the whole group audit as defined in IS 8600, which include all components whose financial information is included in the group financial statement. If an individual component of a group meet the criteria, the audit of the component may be transnational without the group audit being transnational. The length of this audit might be for the purpose of significant lending, investment, or regulatory decision. The difference between an audit conducted within the boundaries of one set of legal and regulatory requirements and a transnational audit are largely due to a variation in auditing standard, regulation and oversight of auditors, financial reporting standard, and corporate government requirements. Auditor must be aware of these different regimes that apply to the audit of transnational entity because they will be bound by the very law and regulation. Given the globalization of business and stock market, this is an increasingly significant concern for many firms of auditors.